My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we are going to cover some of the basic concepts related to current liabilities. So we know what liabilities in general are. They are obligations of the firm, and they generally require the transfer or use of cash or goods or services as a result of some transaction that has occurred. Current liabilities are these obligations that we have that we expect to be satisfied within 1 year or one operating cycle of the balance sheet date. And so we are going to discuss a couple of the basic or more common types of current liabilities. One of the most common types of current liabilities would be accounts payable. Accounts payable are those obligations that arise from normal trade events. So for example, when we buy goods using either an open account or even buy goods using a corporate purchasing card of some sort. When we make that purchase transaction and receive the invoice, we have taken possession of the assets or have received the services but have not yet paid for them, and that generates an account payable. The measurement issues related to accounts payable are fairly straightforward. Normally, when we receive the goods or services, we get an invoice, and the invoice is going to indicate how much we owe, what our obligation is, and that's the basis for measurement. So for example, if we buy inventory using a corporate purchasing card, what would happen is we would receive or obtain the invoice for that inventory, and then the recognition would simply be a debit to inventory and a credit to accounts payable to recognize that we have received the inventory but have not yet paid for them. Accounts payable would typically be classified as a current liability because under the normal course of business we would certainly expect to satisfy that obligation, make the payment on the credit card or pay the vendor on the open account within 1 year. Typically we would expect to do that in maybe 30 to 60 days. Another type of common current liability are notes payable. And actually there are long-term notes payable as well as short-term notes payable. What we're talking about here are short-term notes payable. And notes payable are just simply a somewhat more formal way of recognizing an obligation as compared to accounts payable. If we have a particularly large transaction, or in the event that we are simply borrowing cash from a financial institution, for example, they may ask us to sign a formal note payable, which is just a contract in which we agree to repay principal as well as probably some interest. We will go later on into some detail about the measurement and recognition and disclosure issues related to notes payable. But again, notes payable is a very commonly seen sort of current liability. We can also have current maturities of long-term debt. We can have all kinds of debt obligations, and we'll talk about those in more detail, such as mortgages, bonds payable, leases, and those types of things. And a lot of those long-term liabilities, or for some of those long-term liabilities, we will have the requirement to make some payments in the short term as well as in longer periods of time. So for example, think about a mortgage. You have a 15-year mortgage on your home. You're going to be making some payments within the next year. Those would be classified as a current liability, whereas the remaining 14 years or whatever else is out there would be classified as a non-current or a long-term liability. In general, we probably don't have much in the way of journal entries to deal with respect to separating a lease obligation or a mortgage into current and long-term portions. that a lot of times is just handled in some sort of a spreadsheet analysis where we separate the current and long-term portions. We also have some additional commonly seen current liabilities. For example, dividends payable. Dividends payable is the result of the board of directors voting to distribute dividends to the shareholders, and typically the board of directors will make that declaration, and then it will be 30, 60, maybe even 90 days after that declaration is made that the dividends will actually be distributed. Well, if a balance sheet falls in between those two dates, between the date of declaration and the date of distribution, then we would have a liability to recognize on the balance sheet. The board of directors has stated publicly or declared publicly that we're going to pay dividends. That creates an obligation on behalf of the organization, and so we need to recognize that obligation on the balance sheet. And that would probably come in the form of a debit to retained earnings and a credit to dividends payable. The dividends payable would show up as a part of current liabilities. Unearned revenues are the result of a business collecting cash in advance of providing goods or services. Think about, for example, you need to hire an attorney to do some work for you, and the attorney collects cash in advance of providing those services, collects a retainer of some sort. Well, the cash that's collected is not yet revenue. The attorney has an obligation to either return the cash to you or to provide the services that he or she agreed to do. In either way, the cash that's collected immediately is going to be classified as unearned revenues. And even though we use the word revenue, it is not revenue on an income statement. It is a liability on the balance sheet. Unearned revenues would typically be classified as current liability as well. Normally, we're not going to be collecting cash more than 1 year in advance of the expectation of providing the goods or services. Similar sorts of things happen in other industries. For example, airlines. We will typically collect cash in advance of providing the services. And in fact, most airlines will not allow you to book a flight more than 1 year in advance. That prevents the airline from having to deal with what portion of unearned revenues is current and what portion is non-current. That is removed from the possibilities if you can't book more than 1 year in advance. So if you book a ticket on, say, December 31st for the following December 31st, then the airline still expects to satisfy that obligation within 1 year of the balance sheet date. The other common types of liabilities that we might find classified as current liabilities would be related to taxes, sales taxes payable, income taxes payable, employee-related liabilities, withholding taxes, and that sort of thing, where the business enterprise is simply acting as an agent on behalf of the taxing authority. So when Walmart sells goods, they collect sales taxes. Those sales taxes do not belong to Walmart. They belong to the state taxing authority, and Walmart is simply acting as a pass-through from the consumer to the state taxing authority. So when Walmart collects those taxes, that's going to be credited to sales tax payable, and then the enterprise will periodically remit or pay those sales taxes payable. Same thing happens with income taxes payable, employee-related liabilities, FICA withholding, and income tax withholding, and so on. Again, the business enterprise is simply acting as a pass-through entity to the appropriate taxing authority. But all of those are going to be classified as current liabilities. You can imagine the state taxing authorities don't really appreciate firms taking more than a year to remit sales taxes payable. That'll get them in trouble most of the time. So that is a very brief overview of the common types of current liabilities that we can expect to see on a balance sheet. What I'd like to do is just show you a live financial statement. I've got Google's balance sheet here from the most recent quarter of 2013. And the last column here, the right-hand column, is going to show Google's balance sheet as of June 30th, 2013. And I'm going to scroll down here. Before I do that, though, just to get the scale, everything in here on the balance sheet is in millions. And so now I'm going to scroll down to the liabilities section of the balance sheet, specifically the current liabilities section of the balance sheet. And so you can see that Google lists the common types of current liabilities that we would normally expect to see. Accounts payable, we talked about that. Short-term debt, that's probably mostly short-term notes payable. They have accrued compensation and benefits, and so they have employees obviously working for them. But as of June 30th, they accrued some expenses, but payroll had not been run exactly on June 30th. And so there is some accrued compensation and benefits that is listed on the balance sheet. Accrued expenses and other current liabilities, sort of miscellaneous things. Accrued revenue share has to do with Google's ad sharing revenue scheme. So advertisers will advertise on Google, and Google will remit some ad share revenue to those advertisers. And again, the accrued revenue share is essentially the result of some timing differences between the recognition of the expense and the remittance of the payment. Securities lending payable. That sounds like another sort of note payable kind of thing. Deferred revenue, we talked about that earlier. Deferred revenue or unearned revenue would be the same thing. Income taxes payable. They had some income taxes payable at the end of December 2012. They happen not to have any income taxes payable, or at least not accrued any income taxes payable at this point of 2013. As of June 2013, they don't have any income taxes payable. But that's what Google's balance sheet looks like, and specifically the current liabilities. So they have total current liabilities of just over $15 billion. Now we can see here, we can talk about also one of the measures of financial status. $15 billion of current liabilities sounds like a lot, but remember that one of the measures, analytical tools that we talked about, is something called the current ratio, which is current assets divided by current liabilities. What is the relationship between Google's current assets, those would be the resources that they have available to satisfy these current liabilities. And so we can do that real quick as well here while we're here. Current assets are $66.8 billion, so $67 billion, we'll round it up to $67 billion. And they've got just over $15 billion in current liabilities. And so 68 divided by 15, their current ratio is about 4.5 to 1. So that means that for every dollar of liabilities, for every dollar of current liabilities, they have about $4.50 of current assets. That is a relatively healthy or high current ratio, to have $4.50 of current assets for every dollar of current liabilities. That's a pretty healthy current ratio. And that just means essentially that Google has a lot of current assets relative to their current liabilities, and in Google's case specifically, they have a lot of cash related to their current liabilities. The higher the current ratio is, the easier it is for the entity to maintain payments on those current obligations, and so from that perspective, Google is in very good shape. All right, so that's an overview of some of the basic issues related to current liabilities. In subsequent videos, we're going to get into a little bit more detail with respect to some of the more complex liabilities. For example, notes payable, contingencies, and asset retirement obligations, those sorts of things.